Coming up on Market to Market. Cold weather hits the nation's midsection as harvest nears completion. The top two greenhouse gas emitting nations strike a landmark deal. And we'll examine the increasing role of technology at the world's largest futures exchange. Those stories and market analysis with Elaine Cub and Walt Hackney next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, November 14 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. With U.S. businesses hiring more people last month, there was a little extra discretionary income to go around. Consumers took advantage and went on a bit of a spending spree. According to the Commerce Department, retail sales rose 0.3% in October. Spending was spurred along by relief from the pain at the pump as gas prices have fallen below $3 across much of the country. When the volatile gasoline market is removed from the equation, retail sales increased 0.5%. With fewer gallons of fuel being pumped into U.S. gas tanks, the price of crude oil hit a 4-year low on signs of rising supplies. The increased oil supply and lower fuel consumption prompted the Energy Department to predict the average price of gasoline will be $2.94 a gallon next year. The news helped push the Dow Jones Industrial Average into record territory before falling back at the end of the week. Congress took up the thorny issue of the Keystone XL pipeline this week. A decision on the multi-billion-dollar project that brings jobs, energy security, and global climate change into the same arena has been delayed for nearly 6 years. The U.S. House gave a green light to the oil sands transportation pipeline on Friday, and the Senate is expected to vote on its version of the measure before next week's Thanksgiving recess. Last week, a blue-ribbon United Nations panel on climate change issued a report indicating dire consequences for the environment if nothing is done to reduce the release of man-made greenhouse gases. And this week, leaders from the two nations responsible for 45% of the world's greenhouse gas emissions came together in a landmark agreement. The final hope is that the eagle and the dragon will be able to fly together towards the same goal.
This is a major milestone in the U.S. China relationship, and it shows what's possible when we work together on an urgent global challenge.
Putting differences aside this week, the United States and China, the world's top two emitters of greenhouse gases, announced a groundbreaking deal to combat climate change. The agreement comes on the heels of this month's gloomy assessment by the United Nations Intergovernmental Panel on Climate Change. The panel called for a reduction of man-made greenhouse gas emissions to zero by the end of this century in the hopes of reducing the damaging effects of global climate change.
The scientific community has now spoken, but we are passing on the baton to politicians, to the decision-making community.
The response to the UN's challenge came sooner than expected when the two nations made the historic agreement on the sidelines of this week's Asia-Pacific Economic Cooperation Summit.
I urge all countries, especially all major economies, to follow China and the United States' lead and announce ambitious post-2020 targets as soon as possible.
Under the U.S. China Accord, American emissions will be slashed nearly 30% by 2025 compared with 2005 levels. Obama administration officials say the U.S. is already on track to meet the president's previous target of lowering emissions by almost 20% by 2020. But the revised goal accelerates efforts to cut pollution roughly twice as fast.
I commend President Xi, his team, and the Chinese government for the commitment they are making to slow, peak, and then reverse the course of China's carbon emissions.
While proponents hailed the bilateral resolution to cut atmospheric pollutants, some critics point to China's lackluster track record of keeping its promises. And coal state politicians already concerned over a presidential mandate to cut carbon output they believe could kill jobs and shutter coal plants nationwide were distressed by Obama's New Deal with China's President Xi Jinping.
The agreement requires the Chinese to do nothing at all for 16 years, while these carbon emission regulations are creating havoc in my state and other states around the country.
China, long reluctant to be boxed in on the climate issue by the global community, has pledged emissions would peak by 2030 and then be reduced in the following decades. Currently, China leads the world in greenhouse gas contributions due to rapid construction of new coal plants.
We're an oil and gas producer and could potentially be an oil exporter, providing that source of soft power across the world. What do? We turn our back on the infrastructure that moves this product.
And in the wake of such broad-based climate change initiatives and sweeping midterm elections in the U.S., a lame duck Congress has fast-tracked efforts to approve the long-delayed Keystone XL pipeline. If the Senate passes a bill as early as next week, the president would be forced to sign the legislation into law or veto it.
Let us not miss this opportunity. Let's get our work done on the Keystone XL pipeline, an important project for this country.
But according to July figures from the Canadian Energy Research Institute, the controversial proposition to transport oil sands bitumen to the American Gulf Coast refineries may not be as economically viable as it once appeared. And if the recent trend towards declining crude oil prices continues, the cost of new well production in Alberta could be higher than the return the commodity would provide. Longtime viewers of this program know that we always quote futures prices on market to market. While we also explore ramifications for cash marketers, the bulk of our analysis relies on data from futures exchanges in Chicago. Since 1848, open outcry was the only method of trading at the Chicago Board of Trade, or CBOT. With arms waving and voices raised to the top of their lungs, frenzied traders haggled over prices, and orders were filled with a few hand signals, a nod, or even a shout. But things changed dramatically in 2007, when the Chicago Mercantile Exchange and the Chicago Board of Trade merged to form the CME Group, the world's largest and most diverse trading exchange. Computerized transactions soon emerged as the dominant method of trading. And the knowledge base of who's trading what and how much has changed from observations on the trading floor to phone calls and emails. David Miller explains.
Shouts can still be heard on the floor of the Chicago Board of Trade at 141 West Jackson, but nothing in comparison to the cacophony of the past. Most of the open outcry trading has left the futures ring and now takes place in the options pit. The rest of the action at the world's oldest futures exchange has been reduced to a little more than a mouse click.
It used to be an advantage when we had all the open outcry transparency held down here where we could see the information and we had the knowledge. But now sometimes things happen and there's much more information floating around electronically where we're the fly on the windscreen, per se. We're the last guy to know.
March 434.21 by 2 put spread.
Scott Shellady has been a commodities trader for more than 25 years. A second-generation floor trader, Shellady owns one of the 3,600 seats or memberships on the CBOT, allowing him to trade on the floor. Memberships come with various trading rights on the exchange, but only 1,400 are considered to be full seats. The price of a seat hit an all-time high of $3.2 million in 2006, but prices have declined 92% over the past 8 years to $265,000. And Shellady says the reasons for owning a seat have changed dramatically.
Maybe for actually trading costs at the exchange level, it's an advantage. We trade at a cheaper price as far as the tax that we pay the exchange. But other than that, where it used to be something as an advantage for information. It's not anymore.
These days, Shellady does nearly all of his business electronically, which allows him to trade more than just agricultural commodities. However, he does note the advantages and disadvantages of both spending time in a desk chair and shouting in the trading pits.
Because the customers want both things. They want trade certainty. Am I filled? Am I filled? Am I done? Am I done? Have I done the actual, has my broker executed what I want him to do? And I want to know yesterday. But at the same time, they want to know what everybody else is doing. So if I do that in the open outcry market, I can tell them what everybody else is doing, or I can tell them upstairs electronically, yes, you're done, you're filled, I've done what you wanted me to do. Well, who else is doing what I want to do? I don't know, I just put it into a machine. So for speed, you lose, speed is less transparent. Slower is more transparent. So we can all see what everybody's doing a little slower and disseminate that information, or we can do it really fast upstairs and nobody knows what anybody's doing.
The first electronic trades were made in 1992 on the CME Globex trading platform. Use of the program was limited by computing power and bandwidth. Today, those hurdles have largely been overcome, making it possible to buy and sell anywhere a data connection is available. According to the CME Group, more than 90% of agricultural futures and nearly 55% of agricultural options transactions are no longer executed in the commodity pits. The trend can be seen across the entire exchange as the number of people in the grain and livestock rings diminishes. But as the number of people trading on the floor has declined, the number of opportunities to make trades has increased. In April of last year, the 165-year-old exchange combined the traditional 4 hours of open outcry with 17 hours of simultaneous electronic trading. The new hours allowed the CBOT and CME to reach a volume of more than 265 million futures and options contracts in 2013. This is down 8% from the heavily drought-influenced record trading year of 2012.
I can remember after the close of the grains, and any given day you could go downstairs to the bar or up to your office and sit around and talking about corn, soybeans, and wheat for a couple hours, just soaking up knowledge and comparing notes. You can't really do that anymore. I think that that's been the big loss, and I'm sorry to see that part of it go. On the one side, I can get quicker and better and cleaner executions for myself and my customers, but on the other side, I've lost access to a lot of knowledge that's very, very hard to replace.
Jack Scoville began as a runner on the Chicago Board of Trade in 1981 and worked his way up to being a floor trader. Scoville left the trading ring in 1990 and has been trading electronically for the Price Futures Group since 1992.
The open outcry is a lot more fun, a lot more action, a lot of excitement that you don't really get sitting here in an office, but we can trade with much more certainty. When we get filled price, we know it's a filled price.
While Scoville laments the loss of comradeship in the trading ring, he does point up the advantages of the new trading landscape.
I can remember 30 years ago when I was having to call Brazil for the company I was working at the time, and it could take me a half hour to get a phone line, and then I'd have to try and keep it open all day long. Now I can just call the guys up from wherever I am around the world. I can tell you that I've spent time riding in the back seats of pickup trucks in Central America, passing orders from Brazil to Chicago for my clients.
The CME Globex electronic trading platform also allows for some traders to make a large number of trades in millionths of a second. CME officials have yet to break out how much of the trading volume is made via the practice of high-frequency trading, and they are quick to point out that the most important thing is the integrity of their markets for each and every participant. How and where all the information is gathered and used has changed. In the past, floor traders reacted to the peaks and valleys of various trading cycles. They would often trade in ways that are sensitive to harvest lows, weather trends, and key government reports. But with all the information readily available on the internet, tech-savvy traders can shift the market in unexpected directions.
So there may be a trader in India that doesn't know about those cycles. And so they'll trade against them. If you have enough people doing a one-lot trade, that can be a big trade. And if just so happens they all do it at the same time, you might see there's rain on the horizon for corn. Corn prices should be going down, but enough people have bought a one lot from somewhere else in the world that the market's rallying. So we have to be careful about what's actually happening and slowly but surely somehow take the noise out.
And as more and more commodities on the CME group are traded electronically, Shellady believes it's important to balance knowledge and experience against the pressure of changing times.
You could shoot a cannon through here and not hit anybody. So yeah, it's nowhere near what it used to be. And ultimately, that's not the exchange that decide or the traders that decide. The customer will decide when and if he or she wants to do the business 100% electronically. But right now, there's enough customers that do call people, and we execute in the pit. So as long as that's the same, it'll still stay open.
For Market to Market, I'm David Miller.
Next, the Market to Market report.
The commodity markets had a ho-hum reaction to this month's USDA World Agricultural Supply and Demand report. But despite worry over colder weather affecting the wheat crop, a reduction in the size of an already record-large corn crop, and a slightly bearish soybean report, prices trended higher. For the week, December wheat gained 46 cents, while the nearby corn contract moved nearly 14 cents higher. Soybeans rallied again this week, but prices had declined when the bell rang on Friday as the January contract trended lower by 14 cents. Nearby meal prices also lost ground by $10 per ton. In the softs, cotton declined for a second week in a row as the December contract fell by more than $4 per hundredweight. In the dairy market, December Class 3 milk lost 38 cents, while the deferred contract declined by 3 pennies. Big gains returned in livestock as the December cattle contract gained $3.40. Nearby feeders advanced by $3.67, and the December lean hog contract improved by nearly $4. In the financials, the euro gained 9 basis points against the dollar. Crude oil continued its 7th straight losing week as the December contract settled with a loss of almost $3 per barrel. COMEX gold rallied by nearly $16 per ounce, and the Goldman Sachs Commodity Index lost more than 12 points to settle at 521.30. Here now to lend us their insights on these and other trends are two of our regular market analysts, Elaine Cubb and Walt Hackney. Guys, welcome back.
Always a pleasure.
Elaine, let's start with you. You are a South Dakota girl. You saw a little bit of snow this week up in your neck of the woods.
Yep.
How was harvest coming? Did this have much of an impact up there?
Well, right in my particular neck of the woods, harvest is pretty well done. In that particular region, it wasn't a problem. And in that particular part of the Corn Belt, didn't have the constant rain sort of in the earlier part of harvest that the rest of the Corn Belt has been struggling with. So that winter storm that moved through, and we really seem to be in winter, has two effects, in my opinion, on the corn market and the soybean market too, to some degree, is the Wisconsin and Michigan sort of area where they are very far behind in harvest. This is not going to be helpful. But on the other hand, there's a lot more open piles of corn being stored, and cold weather is actually going to be a little bit better for prospects of keeping that quality, although I think just relatively speaking, we're going to have more quality losses from these open piles one way or another. We've just got much more grain than we've had storage expansion in the past couple of years.
All right, well, then let's jump back to the wheat market, which was pretty exciting this week. What sparked this week's rally?
Well, you could make the argument that it's these cold temperatures again are going down into the southern plains, and I think there was some momentum trying to be built about freezing on the winter wheat crop down there. But this sort of happens every November, and I don't know that that's going to be a very lasting effect. And so wheat really hasn't been following corn and soybeans to this all through the rally during the month of November so far, and I don't think it will. I think it will probably sort of peter out here.
All right. Now, on the corn side of things, you mentioned this cold weather is probably going to be beneficial for all the open storage. Is storing still the optimum choice for folks wrapping up harvest in the corn crop?
Well, given that we are seeing an upward rally here, an upward correction, and it feels like a normal year where you would expect to see a spring high, you've got a situation in South America where they're planting even more soybean acres than they originally planted, which means that they're not looking at planting corn acres. And why would they, with the soybean to corn price ratio that's in place right now, about 2.7 to 1, which is very much in favor of soybeans. So I think there's going to be less corn coming from the rest of the world, and China too, by the way. I think the conventional wisdom says that their corn production this year is actually down 3% from last year. So Actually, I think there's a few bullish things that is going to keep corn moving on a seasonal pattern and maybe looking more towards spring for more highs.
All right, now as we jump over into the soybean market, a lot of folks sold beans straight off the combine. For people that did that, would you advise them to get in and own it on paper?
Yeah, and I'm one of them. I really was bearish on soybeans, and I still am. I mean, they're overpriced compared to corn. The only thing that's been driving soybeans up is this idea of the shortage of soybean meal. Soybean meal made it over $400 a ton again this week, but it didn't stay there by the end of the week. But that just feels like a panicky, short-term kind of situation. And when you've got nearly 4 billion bushels of actual beans in the country, I don't necessarily think it makes sense for the soybean market to be following meal to this degree. So, yeah, I think that there's real potential for the soybean futures market to correct back down. But in the meantime, longer term, again, when you're going into the spring, I have liked the idea of getting rid of them, not trying to keep them in condition and store them physically. But if you want to be bullish on soybeans, do it with options. But
maybe go ahead and let it have a correction, see if the rail will resolve itself and get this meal moving?
Yes, I think that is bound to happen here at some point.
All right. Now let's jump over to Walt Hackney, fresh in from the western United States, bringing cattle off of ranches. Walt, we've got a question here from Pat in Gretna, Nebraska. And he's got a question a lot of folks in cattle country have. What would you do with a set of running but aged cows? Do you sell them, calve them out, and replace them with heifers?
Well, as you know very well, there's quite a spread in what is aged. And now, if they're not extreme aged cows, and hinging on the cold canner cutter type quality, I'd calve them out. I'd get that coupon on the ground, I'd get it weaned, and I would look toward either growing it and selling it or whatever, feeding it out, whatever. But I would keep them. As we speak, it's still probably pretty good mathematics to sell bred cows. This week at a market in Oklahoma, they had bred heifers in there, and they were turning down $2,800 a head for those bred heifers. Now, there were some of the lesser quality that were bringing 26 to 27, and they were talking like that was the cuts. And but the good cattle were getting turned down at $2,800 a head.
Now, that being said, I've heard from a lot of producers this fall that lightweight heifers were the buy of the season. Do you agree with that?
Well, if you're keeping them for market conditions, there's as big a risk in a lightweight, quote, heifer as there is a lightweight, quote, steer. But if you're thinking in terms of herd replacement, and if you've got the equity base to maintain that lightweight heifer for 2 years before you clip a coupon, then you could probably make sense out of the idea of keeping them. But otherwise, it's probably good economics to sell them at these record high prices.
Now, that being said, as we take a look at the fat cattle market this week, we saw a nice little bump. Are the Packers really bidding up to that 170 level, do you think, Walt, here going forward?
Well, they did week before last, and they bought a lot of cattle at $170. They also lost a tremendous amount of money as a Packer. And what we're looking at in this cattle market is that exact issue. It isn't cheap corn. It isn't cheap gains. It is the added tonnage in the feedlots because of overfeeding and extending the feeding period on the cattle that are already completed, plus Packer losses. Those are the two albatross that are hanging over our heads that are going to cause the industry a real issue soon when you couple the heavyweight beef going out. Mike, beef as the 26th of October was 26 pounds heavier than 2013. Now, that's huge when you even put it again the reduced kills of 110,000 head of cattle a day. That's huge. If that continues, and if that's a trend we have to look forward to, then the next obstacle will be overweight hogs. You got the same thing in hogs. we're hinging on 300-pound average market weights in the hogs. Now, that's going to be too much product. So is the cash market going to continue? I think it'll stabilize around $1.65 to 67. I don't see that the packer is going to participate at the party at $1.70. Okay. I don't think he will.
Just as needed, jumping in.
Yeah.
Now, as we look at the hog market, we've had the first cold snap in the U.S., and the cold was supposed to be kind of the harbinger of PED. In all of your travels, have you heard any talk of PED on the hog side?
Only as recent as last night. And there are rumors breaking out in the colder areas, which, as we all know, PED virus is more susceptible to the cold weather. And there is some evidence of PED breaking out in certain areas, as recent apparently as yesterday. There's also some potential of vaccine that's being developed that's going to help us eradicate part of that if we're lucky.
All right, so that will have an impact here as we move into the rest of winter.
It will.
Now, Walt Hackney and Elaine Cub, thanks so much for joining us tonight, and we will have a lot more talk in the Market Plus segment on our website. But that wraps up this edition of Market to Market. We will answer more of your questions, as I mentioned, in our Market Plus segment, and you can also find audio podcasts and streaming video of our program, as well as links to our Twitter feed, Facebook page, and the rest of our social media outlets exclusively at the Market to Market website. And be sure to join us next week when we'll see farmers trade their combines for husking hooks as a rural tradition is kept alive through the annual National Corn Husking Contest. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.